Okay.
So we can go live now. We can start.
We will start. Thank you, Nilesh, for joining us. And dear participants, good afternoon to everyone. Welcome to IIFL webinar on Decoding the Budget 2023. We have with us Mr. Nilesh Shah, who is the Managing Director of Kotak AMC. Nilesh is has over 3 decades of experience in capital markets on both sides of the table, both on the investment side as well as on the banking side. And he's one of the persons who I feel is most uniquely placed because he has managed funds across cycles and across asset classes. He is one person who has got deep and vast experience of not only equity capital markets, but one of the few who understands fixed income very well and also real estate. And not only for Indian investors, but also global investors. So we are very privileged that we have somebody who understands the pulse of the Indian market so well and has seen Indian capital markets from close quarters, right from the days when the stock exchange was a ring to now when everything is happening electronically. Thank you so much, Nilesh, for joining us. And first and foremost, I think yesterday's budget, the finance minister has done a very, I would say, a commendable job of making sure that growth is taken care of without overshooting on the deficit side. So that way I'm sure you'll be happy that she's been quite disciplined. So now we are talking about twin engine budget because to drive growth, you have the engines of both capex as well as consumption to hopefully drive growth after 2 years of almost stalled situations after COVID and all kind of problems. So first and foremost, what's the big picture view on the budget?
This is like a Bahubali budget. Amrendra Bahubali can shot 3 arrows from 1 bow. The finance minister has also done something similar. On one side, she has given more money for investment. It is more than what was expected by people. Second, she has given more money in the hands of taxpayers so that they can go out and spend money. And finally, she has also reassured investors by pursuing the path of fiscal prudence. This year, deficit is down 50 basis points. Over next 3 years, deficit will be down by another 150 basis points. So effectively, with one budget, finance minister has achieved multiple objectives. And if I want to draw one thing, see, from 1947 till 2013, what infrastructure we built, we are trying to build that between 2014 to 2024. Our highways were 80,000 kilometers in 2013. With this kind of budget, it will be 165,000 kilometers in 2024. The power capacity was 225 gigawatt. It will be 435 gigawatt by 24. The coal production will go from 600 million tons to 1,000 million tons. The railway electrification moves from 20,000 kilometers to 50,000 kilometers. So effectively, we are trying to do in 10 years what happened over 67 years. And this budget is continuing the same tradition. Hopefully, benefit of this massive infrastructure build will be visible. In the city of Mumbai, in which both of us are staying, the total railway built from Britishers' days of 1853 till probably a few years back was 190 kilometers. And in last few years and over next few years, there will be 310 kilometers of railway track. So what we saw in slow motion in 67 years of independence, we are now seeing in fast forward.
So basically the entire capex is productive capex on infrastructure growth, and we will see, not hopefully, but surely trickle down the effects of these huge infrastructure spend, and economy growth should accelerate in the days to come.
So, Venkatbhai, we also have to take some tough decisions. For example, our passenger fares haven't changed for many, many decades, I'll say. And the burden of passenger fare subsidies on commercial freight. This makes my logistics cost 5-6% higher than my competitor. Similarly, we give free agriculture power. The burden is shared by industrial power. My power cost makes me 4-5% more uncompetitive to peer. My competitors in export market are running normal race. I'm running hurdle race thanks to the subsidy burden of agriculture power and subsidy burden of passenger fare. At some point of time, we have to unburden our entrepreneurs. Then they will go and win war or competition in the global market.
So that's a very valid point, because entrepreneurs in India are fighting two battles on both on the freight and power, which, as you know, especially if manufacturing, make in India is very important, because those two are important costs. You can't wish them away. But given the fact that 2024 is maybe 15 months away, so I don't think this kind of painful decisions will be taken so easily.
We should not even hope for, but at least we should talk so that 10
Aim
years
for,
down the line, our kids won't have to worry about these things.
That's a fair ask. I think we cannot hope for, but at least we can talk for. That's a fair statement. I take you on this. Now coming to the interest rates. I actually, now yesterday also there was a Fed meeting and statements like that. And you, as I know personally, since I have the good fortune of working with you, so you are one person I would say confidently that you understand interest rates and money markets better than anybody else. So what is your view on interest rates, if I can?
So on interest rate, there is a reasonable amount of clarity that it will peak out soon and may even start coming down towards the end of the year. The US Fed chairman is caught between devil and deep sea. If he keeps interest rates higher, he will induce a recession, and he may convert a recession into depression if rates remains higher for longer. At $31 trillion of debt, they are like on the Star Trek journey. That debt mountain is where no man has gone before. 1% increase in rates means $310 billion gone. They don't have that space in budget. At the same time, if he doesn't raise rates, inflation will be higher. Credibility of Fed is already under question. Fed is trying to walk left and talk right. It doesn't want market to front run Fed. And that's where we believe Fed will continue to kind of deter market by slightly hawkish behavior. But eventually, US Fed interest rates will peak out by April, May 23 and start coming down by December 23 as per the market expectation. That lays foundation for India. Oil, coal, and fertilizer prices are down, so our inflation will be lower. Second, our fiscal deficit is under reasonable control. Liquidity is decent. As Fed starts cutting down interest rate, it will create elbow room for us. So I will say in the first half of CY23, 10-year gilt will move between 7.25, 7.5. And in the second half, it may move between 7.25.
So you're saying that as early in the next 12 months, we will see a rate reversal. If not reversal, then at least stagnation and gentle sloping down.
Definitely, we expect stagnation and then reversal in interest rates, because high liquidity and low interest rates are like steroids. It has infused, growth in Western world. They won't be able to stay away from it, just like Bank of Japan didn't stay away for a long period of time.
Yeah, actually, what you say is correct. Low interest rates, high liquidity is like steroids, and at least in the startup world, we have seen the ill effects of such steroids, consumption of such steroids.
Absolutely.
So coming to my next question, which is on flows. So now we are slowly seeing China opening up after maybe. First of all, China itself is opaque, so I don't think we also read whatever papers and then comment. So, opaque world, they slowly started opening on, maybe sunshine is slowly going in. So, but apart from sunshine going in, also money is going in because the foreigners are are getting back into China in a big way. So, and if you see in the last 2-3 months, FI selling has been very, I would say in Indian markets also been extremely high. So basically my question is as follows, that I know that you have been a big proponent of the need to have domestic liquidity high, but still foreigners are at the margin quite an important stakeholder, player, or whatever you call. So what is your view on the foreign flows?
So Venkat bhai, there are 2-3 trends that play from a global investor point of view. In the short term, active fund managers think, should I take profit out of Indian market, which is giving me profit? In other markets, I don't have any profit, which is giving me exit. There is local market, which is liquid. I can sell $8 billion of a particular financial group and still get money back. And third, the valuations are expensive. All 3 conditions of liquidity, valuation, and exit is met, and hence they're taking some money out to invest into cheaper markets like China, Brazil, South Africa, Indonesia. However, the longer term money, the strategic money, they will continue to invest in India because this is one country which will go from 5th largest economy today to 3rd largest economy over next 7, 8, 10 years. There's no other country where you could be sure that they will grow like India. The governance standards of India are fairly good, and the commitment to green energy and green transition is highest in emerging market in India. Where will you get this 3G combo of earnings growth, good governance, and green commitment? So we will have tactical money leaving India because we delivered so much return to them, and strategic money still coming back to India, albeit not necessarily at current valuation. Then the second thing is passive money. Over last 2 years, passive monies were withdrawing from emerging market because US interest rates were attractive. Now, if and when US interest rate starts coming down, money flow will move towards passive emerging market equities. Passive money, whenever it comes to emerging market, 14% will come to us because we are having that much weight in index. So we will see tactical outflow of FPI, strategic investment of FPI, albeit at lower valuation, and we will see passive inflows as and when the tide turns on US interest rates. This is how broadly you will see foreign portfolio behavior in the days to come.
So clearly what you're saying is that in calendar 23, in the second half, with outlook on US rates softening, coming down, money should come back to India, maybe at a rate which we don't know, but surely money is going to come back to India.
And we should also try to increase our weight in MSCI emerging market. Today, South Korea is part of the emerging market, but they are already developed market at $35,000 per capita GDP. Let's move them up into developed world. If that happens, their 10-11% weightage gets distributed over rest of the emerging markets. We may get another 1% increase from that. The second thing is about HDFC Bank. HDFC is part of MSCI index. HDFC Bank is not. Now, can you keep India's largest bank having a fairly large foreign ownership out of emerging market index? Now, if HDFC Bank goes into the index on merger of HDFC with itself, that will also increase weight. So if we can pull HDFC Bank's entry into MSCI and Thailand, South Korea's exit out of emerging market, put together, our weight will go from 14 to 16. That will attract more capital to India. So not only we should let our valuations work magic, but we should also try to bring more flows into our country.
And another related question, you have been a big proponent of getting more and more debt flows also. So as you talked about the indices, so what is happening on that front? Because I think since the time we have started our careers way back in the 90s, so the debt markets or corporate bond market, retail bond market, retail. So what is because you are somebody who's very passionate about these things. So I would really we will benefit from your words on that.
So on the debt market, despite repeated attempts by regulators and players, we haven't got that depth which is there in Western world. And partly this happens because the systematic liquidity in banking system is almost similarly moving in direction. Either everyone is short or everyone is long. And hence, either everyone becomes a seller of debt paper or everyone becomes a buyer of debt paper. We need to create counter liquidity that can come from foreign investors. Now, thanks to the rapid rise in US interest rates, attractiveness of Indian 10-year Indian government securities or bond has come down. In fact, today, if you invest in offshore Indian bonds, you get more return on a fully hedged basis than when you invest in local bond market. But time will turn. A day will come when American interest rates will be down and we will become attractive to global investors. We must lay a roadmap or a pipe so that when we become attractive, money can start flowing to our country. The best thing to achieve that is to become part of bond index.
Bond index.
A lot of work is going on. My feeling is that towards probably next 1 year, we will get included into bond indices. There are very few borrowers which world can trust in terms of repayment. And especially in Southeast Asia, countries from Sri Lanka to Pakistan to Nepal to Bangladesh are far weaker credit compared to us.
Actually, that way we have our credit is underappreciated. Because if you look at our history, we have not done anything, and look at all Latin American countries where people put so much money, they always lift their hand.
So many a times, Venkat, my daughter asked that, Papa, the world's largest borrower is US, and they were rated AAA and AA+. And the world's largest lender was Japan and China, and they were rated much lower. So when you borrow more debt, do you get higher rating, or when you invest more money, you get higher rating?
I think your daughter, since she's your daughter, she shares your genes, I'm sure, and she's a Gujarati. So she's asked a very pertinent and a very logical question. And coming to one more point, in this budget, the tax arbitrage between various instruments have gone away. And I know for a fact that you are one of those people who talk about tax arbitrage between various instruments, especially as different asset classes treated get differently. So are you happy that at least most of the arbitrage has been removed, especially the MLD being taxed at high rates and stuff like that?
So undoubtedly, there was a rumor about capital gains tax getting altered. And when we say alter, it means they were going to increase.
At least, if not increase, at least the holding period should have increased.
Absolutely. So it was important to bring to the attention of regulators and authorities that there is a way to raise taxes without increasing capital gains tax rate. And which is where my focus through various communication and representation was that, one, capital gains is not concessionally taxed. There is STT, which was in lieu of capital gain. And now there is capital gain. So STT plus capital gains put together, there is no concession. In fact, there is over taxation. Second, there were loopholes which can be plugged. The first loophole was market-linked debentures, strips in government securities, which converted interest income into capital gains. This was benefiting few and needed to be plugged. I'm very glad that Finance Minister accepted that suggestion. The second thing was related to SME exchanges, where in few cases we have seen capital gains tax planning being done. Clearly, regulators can focus upon there. The third thing is related to indexation benefit of gold. We requested that anyway Indians have invested far more in gold than what was needed. It's time to make investment in gold a little bit unattractive, remove the indexation. I'm sure someday it will get accepted. The fourth thing was related to switch between ULIP, which is tax-free, compared to mutual funds, which is taxable. Now, such kind of tax arbitrage again pushes people to invest into ULIP. Now, the action has been taken on the HNI insurance policies. I'm sure someday ULIP inter-schemes which also will come to the attention of Finance Ministry. Our whole objective is that let's not induce investors by offering tax concessions. Let's create a level playing field, and the one which is beneficial to investors should receive the flows. In our tax regime also the same thing is happening. People are moving from old to new tax regime where there will be no concession for investment in certain select instruments. People pay tax and then they are free to deploy money wherever they want to. Let market forces prevail to allocate in allocation of capital rather than tax incentives nudging here and there.
No, that's a very good point. But so in the days to come, maybe sometime, so even the holding period of the various asset classes, do you think she'll normalize it? Because real estate is some years, debt is 3 years, equity is 1 year.
Was given that there should be harmonization of
Correct.
holding period across all asset classes. I'm sure Finance Ministry has taken certain steps. They will remember what other steps are pending, and they will continue to move forward in the direction of simplified tax, less concession, and less arbitrage.
Thank you so much. I think now we should open the webinar for public questions. So we have audience, some people who are very interested in asking questions. So I'll ask Subhajit to moderate and do the needful.
Yes, we have a couple of questions. The first thing which probably a lot of our customers trying to understand, and they have put it onto the chat, that where to invest now, whether it is Indian market that they should take down or probably any other overseas market like China or any other market.
So Subhajit, China is becoming overcrowded trade, and in the near term, it may still outperform Indian market, but it will be a narrow window opportunity because generally consensus is wrong. The time to invest in China was probably 2 months back when the gap between us and them was almost 100%. Now that gap has narrowed down quite significantly. I still believe the US market provides better opportunity, notwithstanding jump in Nasdaq in last 1 month and a Meta stock going up 20% yesterday. The broad recovery in US is fairly good, and hence US market should be considered for investment. Unfortunately, in mutual fund, we don't have much limit available, so you'll have to use LRS route to invest overseas. And in LRS now, do remember that there is tax collected at source incidence. If you are a long-term investor, then you still need to keep some allocation to India, or dare I say majority allocation to India, because our markets will continue to outperform most of the global markets for a longer period of time.
Sir, another question which was just coming, let's say for an example, as you have said, that there would be a level playing field, not on the side of based on the taxation that an HNI should invest. But at the same point in time, there was a lot of customers who were looking for a non-par as a product for an insurance to come in. Now, how do you see that there would be, because there are banks, there are a lot of institutions are also fairly dependent onto insurance as a business. And also in case of a lot of cases, which is a fixed income yield product, how that will shape up in going ahead?
So insurance industry will continue to grow. There's no doubt about it. In India, insurance is under-penetrated. We need to provide life, general, accident, and health insurance policy to every Indian. So banks will have to focus on expanding the insurance coverage, and they are in the best position to do with their persuasion power and branch network. Coming to the HNIs who were investing into non-par products, well, you can't have a scenario where 7% government securities gets converted into 7% tax-free return or 6% tax-free return. That's not good from the long-term capital market point of view. and that loophole gets plugged. Now they have to follow disciplined asset allocation. They have to take advice from distributors or advisors like IIFL and build portfolios, taking risk to generate return. This tax arbitrage giving you riskless return, that has to come to an end, because the benefit which HNIs were enjoying, someone else was paying the cost for it.
Correct. So we have a few questions which we have received beforehand from the customers while registration. Piyush, can you please ask those questions from our panel side?
Sir, first and foremost, it's a very regular thing. I'm sure you would have answered since yesterday. What the finance minister has announced on the tax change in tax slab for individuals. So if you know, what is your take on that, and how do you see that, in coming time, how it will impact the common investor?
So one, there has been marginal changes in the taxation slabs. They are all in the new taxation policy, not for the old. And overall, as per the budget document, it's a provision of about 35,000 crore worth of tax benefits to taxpayers. But in a country of 140 crore, about 7.5 crore people file return, and about 1 crore people pay tax. The rest are all filing return just for the sake of it. Undoubtedly, there is a massive tax avoidance in India. Geographically, we are in Asia, but mentality-wise, we are in Africa. Our tax compliance, our tax to GDP ratio is comparable to African standards. There are many people who still believe in the non-cooperation call given by Mahatma Gandhi. They haven't yet realized that now their tax doesn't go to UK Treasury, it comes to India. So we need to improve tax compliance. We need to move India from Africa to Asia. And this can only happen with better tax compliance. Today, salaried class is taking the full burden of taxation. And I'm not saying they are the honest taxpayers. They are honest because tax is deducted at source. The businessman is probably not paying fair share of tax. Let's improve tax compliance so that we can genuinely provide tax concession to the taxpayers.
And so a very, very common question that, all of us would want to, understand from you as an investor, which all sectors, you are looking out to, add more in your portfolios at Kotak Mutual Fund, notwithstanding what had been said by the finance minister yesterday.
So one, infrastructure sector looks good because allocation has been increased, and thanks to election and G20, execution will be speedier. The second sector to look at is FMCG consumers. Generally ahead of election, which is about 18 months away, government starts putting money in the hands of bottom of the pyramid. And this money moves in rotation as these people continue to spend rather than save. Put together, there will be more demand from liquor to other consumer staples, and hence FMCG sector should do well. One sector which I want to invest for 10, 15, 20 years, and when I was working with Venkat at ICICI Securities, we used to talk about IT sector. There was a gentleman who had come from Kolkata and taught us about Y2K. In those days, IT sector looked in infancy, but he was suggesting that one day we will have companies employing 1 lakh, 2 lakh IT engineers and exporting services. A similar trend is going to happen in healthcare sector. 1/3 of doctors in America are made in India. 45% of medicine consumed by Americans is made in India. We are also now providing nurses to the rest of the world. In Kerala, when I went in, some of the people told me that in embassies, there are 2 lines, one for nurses, quick visa, permanent visa, temporary visa, long-term visa, whatever you want, it's available. And for rest of the ordinary Indians, there is a long queue. We are also producing medical equipments. There is a PLI scheme for medical equipments. Like in IT industry, we had engineers. we have all the raw materials for providing healthcare, nurses, doctors, medical equipments, knowledge, medicine. Can we, over 10, 15, 20 years, create a company which will employ 50,000 medical professionals, having onshore and offshore servicing model? Obviously, it will be physical as well as digital, and be as big as today's IT company. My feeling is that it will happen. And healthcare also provides that kind of long-term opportunity. It's not a 1 year, 6 months, 2 year call. It is 15-year, 20-year call.
One more question from the audience. One of the people are asking, what is your view on gold?
So gold, there are two forces at play. Globally, central banks are buying gold because they saw what happened with Russia. You had $650 billion of wealth, 500 invested in US Treasury, European bonds, Japanese bonds, $150 billion gold. When you invaded Ukraine, you suddenly realized that you are left only with $150 billion. Every central banker around the world is going to be cognizant of this and build gold reserves. The highest ever buying of gold by central bankers happened in CY22. So there is additional demand from central bankers to buy gold. Traditionally, we have seen whenever US interest rate comes down, gold prices get supported. A part of it is factored in it at gold at 1925, but we still believe there is a room for upside. And gold and silver both should be considered for your investment allocation. Now, the challenge from India point of view is gold taxes. There is 16% tax incidence between GST and import duty on gold. What you get for $100 in Dubai is $116 in India. This has encouraged gold smuggling. Today, when you want to buy gold in bulk in Mumbai, you get 3.5 to 4% discount. I'm sure if you bargain hard, you'll get 5 to 6% discount. At some point of time, government will recognize that gold smuggling needs to be stopped. They will reduce import duty. On that day, you could lose 16% of your rupee value of gold if import duty becomes zero. So please invest in gold, keeping this in mind. Do keep dry powder in case import duty gets cut and you need to average your gold investment.
That's a very interesting feedback. Second question is, somebody again asked a question which is, I would say, interesting. His point is that in America, there's all kinds of problems. There are job losses, inflation, so-called slowdown, fintech blow up, all kinds of crypto blow up and stuff like that. And still, US markets are doing so well. So I'm sure you will say that markets are a forward indicator, but still, I would appreciate your thoughts.
So Venkatbhai, US is an amazing economy. It is self-sufficient in nature. They have land, they have natural resources. They don't have to import oil. They don't have to import agriculture products. It also encourages innovation. People with ideas can go there and become market leader, become billionaire. It attracts talent all over the world. The best of the Indians, Chinese, Japanese, Europeans will be there in America. Their education system is superb. Put all these things together, it gives resilience to the economy. Whenever they have failed on cryptos or NFTs or job losses or recession, they quickly turn around and rebounded by correcting their mistake. Today, barring China, there's no other country which can match US in terms of innovation, in terms of resilience. So US markets will continue to do well, in our opinion, as long as they follow this path of attracting talent and building innovation.
Perfect. And one more follow-on question to the question on gold. So somebody is asking, how do you invest in gold? Whether they should, physical gold is clearly 16% is a big hit. So what about, so the question is that case, if you're wanting to hold paper gold, so which is a easier or a smoother way to?
The best way to own gold will be through LRS. You straightway get 16% advantage. Now, not everyone can afford LRS. In that scenario, you can look at sovereign gold bonds. The sovereign gold bonds has 2.5% coupon
interest.
So even if import duty comes down over a period of time, interest will cover the import duty loss. Other than those two options, the next option will be gold ETFs and gold index funds. The impact cost of transaction is very, very low in this funds. You want to buy 10 gram gold or 15 gram gold, you pay 25-30% premium. In ETFs index fund, it is less than 0.5% or 1%. And if all three are not possible for you, then the worst option will be buying physical gold. It can always be looted. You have to focus on quality. So my recommendation, LRS, go and buy gold on offshore market. You'll get 16% more quantity. Sovereign gold bonds, gold ETF stroke index funds, and finally, physical gold.
Interesting.
So
The other question about fixed income. So now there were, I would say, competing products for fixed income was this arbitrage, tax arbitrage between GSEC and insurance. That is gone. So REIT is, I think, again, because of this entire tax changing of the tax treatment of receipts, again, it has got negatively impacted. So how do you, for an investor who is looking at fixed income, what is your suggestion?
So my ideal suggestion will be to get into funds which we call tortoise and hare category.
Sorry?
We call them tortoise and hare category of funds. Every investor wants a fund which will run like rabbit on the way up in the market and walk like tortoise on the way down. We have created this kind of fund in balance advantage category and equity savings schemes category. We invest higher amounts in equity when markets are cheap, like in October 2008, like March 20. And we invest lesser amount in equity when markets are expensive, like in January 8 or October 21. This change in allocation based on valuation of the market reduces volatility, and hence when the markets are falling, we look like tortoise walking. Slow falling, but much slow. Similarly, when we buy more when markets are cheap and market rallies, market recovers, we run like rabbit. These are the best funds for investors looking to invest in debt. Volatility is less than equity fund by a significant margin. Returns is comparable to equity fund over a cycle. Now, again, this has some volatility compared to debt products. If this volatility is unacceptable, then you can look to invest into dynamic bond funds or bond funds which go and invest into corporate papers also. So between this combination of senior citizens where limit has been increased and where you get higher rate, bond funds and gilt funds, and balance advantage fund and equity saving schemes, you should be able to construct a fairly decent portfolio which will have characteristics like debt and slightly better return than debt.
So balance advantage fund is one category. Senior citizen, I would say for them, fixed deposit is only a good option.
Very important category. You get 30 lakh rupee investment at a higher rate. You must take advantage of it.
And the third is a dynamic bond fund or a corporate fund. So between the three of them, take your risk appetite and make a call and be happy with it. Okay. One more question from the audience. Pharma sector. You spoke about healthcare as a great opportunity. I'm assuming healthcare encompasses pharma, hospital, and the entire package. So, what are you? So,
I'll recommend investment in pharma sector, but this is not a 1 year, 2 year call. This is 10 year, 15 year call. And if you remember, Venkat bhai, when we started journey in technology investment, so many companies failed. Our failure rate was far more than the success rate, but the successes delivered so much return that those losses we could absorb. The same thing will happen in healthcare sector. So please go from what I call as monkey to gorilla to King Kong strategy. Please invest in diversified portfolio of pharma and healthcare companies. They are all the monkeys. Some of them will grow to become gorilla, and one of them will grow to become King Kong. Some monkeys will die. Don't worry. Keep on investing in monkey, which is transiting to become gorilla, and keep on investing in gorilla, which is transiting to become King Kong.
So effectively, I would say that for a retail investor, small investor, fund is a better option than wasting time and energy in identifying stocks.
Absolutely.
So
Absolutely.
pharma fund is so your theme, big theme, healthcare sector is a way to play the healthcare sectors to buy a pharma fund.
Yes.
I would recommend if Kotak has a pharma fund, then surely Kotak.
I don't have, but I will launch one.
Okay, done. So I think we'll wait for that launch, because I think what you said is correct. There'll be a gigantic opportunity in this space. One more question from my side is that, many people are afraid to invest in stock markets, thinking that kabhi bada hai, ghatega. So when badta hai, to they say, I'll invest when it corrects. When it corrects, then say that, let me wait for proper full correction. So, and you're somebody who has seen the entire market from very close quarters. So what is one advice you would give to investors, saying that don't worry,
Venkat bhai,
invest this way?
Cricket का मैच खेलने जाते हैं तो are we saying that we should only get half volley? वो सामने वाला भी बॉलिंग कर रहा है, वो कभी बाउंसर डालेगा, कभी यॉर्कर डालेगा, एक हाथ सर पे भी लगता है, एक हाथ हाथ पे भी लगता है, बट मैच खेलते रहे तो जीत के आएंगे. It is important to stay on the pitch and wait for that half volley to come, and be mentally prepared to take some blows. That's how all of us played cricket, and we were good at that. The same is needed in market. Stay in the market, because you will get some half volley, like you get in March 20, like you got in 2013, like you got in 2008. Will there be some blows to your body? Of course it will be, like it happened so many times in so many sectors and companies. पिच के ऊपर खड़ा रहो, हाफ वॉली का वेट करो, hit it at the right time.
Good, thank you. And one more person has a question, which is coming to P notes. So there's a big rumor that the P notes are going to come back in a very big way, thanks to the latest announcements.
Yes, in the GIFT City, government has proposed that if a broker is issuing P note, then the investors will not have to pay any capital gains. Now, as I mentioned, FPIs are selling because our valuation premium to others is high. If they don't have to pay 15% short-term and 10% long-term capital gain, to that extent, valuation premium narrows. And I believe many fund managers across the world will be burning midnight oil to figure out a way to invest in India via GIFT City P note.
So now we're turning the clock back, because I thought last 5 years the regime was for more transparency and finding end user funds, and now P notes are coming back. Anyway, so long as funds are coming back to India, it's good.
The more we travel further, we realize we are in the same place. Dunya goal.
That's a Dunya goal. And you're launching a banking financial services fund also. So please, somebody's asking your views on banking stocks. So since we have you in the speaker, so you can directly speak.
Venkat bhai, BFSI is the engine to the India train. No industry can grow without finance. If BFSI grows, the entire industry will grow. We believe BFSI today is right now in Cinderella time. NPAs are low, margins are high because rates are rising. The deposit growth is reasonable despite tightening liquidity. With this increase in senior citizen limit, they'll be able to mobilize deposits more. And credit growth is huge. And all the borrowers, thanks to CIBIL, thanks to monitoring, has become like Yudhishthir, very prompt in payment of their dues. Put all these things together, banking sector and financial services will do well. Last year, PSU banks delivered fantastic return. Some of the private banks also delivered very good return by virtue of re-rating. That opportunity is not going to happen this year. But will it compound money over a period of time? Answer is undoubtedly yes. This is a compounding story rather than multi-bagger story.
But in this fund you'll buy only banks and banks. The other related sectors like insurance, mutual funds, all those things will not be a part of this.
No, it will be part of it. It is full banking and financial services. So banks, NBFCs, broking, wealth management, insurance, all kinds of, and fintech, all kinds of companies.
Okay. So the entire financial services, banking and financial services, that's I think a good thing. And apart from BFSI, healthcare, any other funds you will recommend on a sectoral basis or see basically, sorry.
So I will recommend Venkat by manufacturing theme aka infrastructure sector. We believe China +1 and Europe +1 is pushing India's manufacturing sector to better days. Of course, as I mentioned in the beginning, our logistics cost and power cost is a challenge. But we have shown in mobile phone and toys that despite those hurdles, we are able to turn it around from being net importer to net exporter. Manufacturing theme gives you a far bigger canvas, from chemicals to capital goods to engineering to toys to garments. You have a large choice available. Infrastructure becomes far more narrower. There you are in construction, cement, capital goods kind of companies. So for conservative investors, I will recommend manufacturing thematic fund. And we do have Kotak Manufacture in India fund, which has done very well. And for risk takers, aggressive investors who want sectoral focus, they can look at Kotak Infrastructure and Economic Reforms Fund.
So effectively, somebody in the audience has asked the question. So on your behalf, if you can answer, Kotak Manufacturing Fund. If you're high risk, then Kotak Infra Fund. On a very compounding kind of story, your new fund which is coming, which is the banking fund and healthcare fund. Since you don't have, I can't comment on that. But the other fund which you are saying is a good for long-term play is both FMCG and IT, relatively less volatile.
Absolutely.
I think with this, we have come to the end of the conversation. Thank you so much. Any last questions, Subhajit and Piyush?
No, just last thing, there are a lot of customers who are looking forward to understand anything on the IT sector and the telecom, your view about the IT and telecom, because there were a lot of stress which has been made yesterday during this budget.
So on the telecom sector side, the government policies, the regulatory landscape changes very fast. Anyway, there are only 2.25 companies available for investment. So my recommendation is that please don't consider telecom sector as an investment. It has a lot of regulatory unpredictability, which as a fund manager, you can never forecast. And hence, telecom can become part of your diversified portfolio through a diversified fund rather than sectoral exposure. On the IT sector, I believe NASDAQ has bottomed out and it has started moving upwards. This will provide support to Indian IT companies whose valuations have corrected and growth estimates are reasonable. One can start looking to invest in IT companies over next 3 to 6 months in a STP basis. There will be some volatility, some upside, downside, but on an STP basis, one can invest.
Okay. With this, we come to an end. Thank you so much, Mr. Nilesh. Thank you so much, Mr. Venkatraman, for joining us in this talk show. Thank you so much, all our customers and the employee for joining us in this session. We'll very soon have similar kind of a session where we will discuss about various investment opportunity. Stay tuned with us with IIFL Securities. Thank you so much for joining us.
Thank you, Nilesh bhai. Thank you so much.
Thank you.
Thank you.
you.